Let's bring in Jim Newsome to talk more about this. He's CEO of the South Carolina Ports Authority, and he joins us live from our studio up in Hong Kong. Still with us, of course, our guest host, Eric Robertson. Jim, let's start with you. Front loading. You've observed that happening of shipments from China. That was happening in late autumn, and it'll probably continue up until the trade truce expires in March. So deal or no deal, trade uncertainty is going to linger. Does that imply that seaborne freight drops off dramatically from the second quarter onwards?
We think it does, Sheree. Good morning. We've handled record volumes through January and last calendar year. There were some 40 extra loader ships which supported the front loading. The anticipation is that from February there'll be about 40 blank sailings, depending obviously on the impact of a trade truce or not. So I think the 3 or 4 months from, say, March through June, we'll see lower volumes, because of the front loading that was done earlier.
And when you talk to shippers, both in this region and at home in the States, Jim, what's the mood? How would you characterize it in the industry, and how optimistic are they of a trade deal?
Well, I think everybody, there's a lot of unknowns. We've not dealt with this before. I mean, we've dealt with a sort of increasing trade picture for the last 20 years. And I think uncertainty is worrying everyone today. There was already a shift in manufacturing to Southeast Asia from China due to increasing wages. I think that the impetus of that is increasing now due to the trade uncertainty. And I think uncertainty is not a friend of growing trade. I mean, there are no new projects today in the United States for new development of manufacturing and distribution because of the uncertainty.
Hi, Jim. It's Eric Robertson. Good morning to you. At what point do you believe that we can actually see tangible progress on the trade front? I mean, a number of our clients expressed to us that they can anticipate an extension of the deadline between Trump and China. But at what point do you feel your clients and your counterparts in the region would start to get comfortable again that we'd sort of put the bottom in this cycle and we're starting to see a recovery?
Well, I mean, I think it could start today if there's some progress in the trade talks, and obviously if there's a follow-up meeting between President Trump and President Xi. So that would be very helpful. And I think it varies per industry. I mean, if you look at the retail industry, retailers still have to source from China. There's really not much choice in that. Agriculture products are different. Soybeans can be sourced in different parts of the world, so there were more immediate impacts there. I think the industry to watch is the global automotive industry, because the fact is you can make an expensive car anywhere in the world and ship it relatively cheaply, and they have the most potential to make structural change in trade flows as far as I'm concerned.
Jim, do you personally expect any kind of breakthrough at this latest round of trade talks between the U.S. and China?
I wished I knew. I mean, it sounds that there's some optimistic tones coming out of these meetings, and I hope so. I mean, I think what's not really being talked about very much, Sheree, is the fact that there's a lot of infrastructure invested in a global supply chain, both shipping lines. A ship system is $1 billion. Ports, we're investing $2 billion in our port system in a 6-year period of time. And all of those are really to support trade and more specifically trade with China. I mean, there are 10 ports in China that are over 10 million TEUs. So any shifting and significant shifting in sourcing has an impact on the reliability of the supply chain. And I don't think that's being very openly discussed.
What would be your message to the president?
Look, I think that the assessment of the issues bilaterally is correct. I mean, there are issues that they're bigger than trade. Intellectual property, obviously access to markets. I have no question about the diagnosis of the problem. I think it's right. I think there, however, has to be a solution soon. The longer the uncertainty goes on, the more risk, the more change there is in the supply chain. And it's hard to micromanage trade. I mean, David Ricardo had it right. Free trade is a good thing. And there are a lot of cause and effect to changes in trade. If China's economy doesn't do well, I mean, the U.S. is counting on selling to a 500 million person middle class in China. If that would change, obviously it affects our export picture as well. So there's a lot at stake in getting this settled.
Jim, and if tariffs do go from 10% to 25% come March the 2nd, how much of a body blow will that be for shipping flows if that does happen?
Well, again, it varies per industry. Our economy is strong, as you cited earlier. I mean, job market's good. Our imports have grown a lot. But retailers have little choice but to source in China until they can move production elsewhere. That takes time. So that would indicate you would see increased prices as the major impact of that. So the elasticity of demand would really determine what's shipped. Ag products are different. U.S. soybeans can be substituted by Australia soybeans, Brazil soybeans. But then the longer term is, again, this automotive, this sort of globally sourced automotive industry where companies like BMW ship 70% of what they make in South Carolina and export. To the extent this goes on longer and longer, they can potentially plan differently for their manufacturing. So those are the structural changes like that are the things that can really impact our business long term.
I thought it was very interesting what you said earlier, Jim, about this region and especially the ASEAN region, and that implies that shippers are getting a little bit more creative and rerouting goods and cargo through Southeast Asia. Can you just elaborate on that trend?
Certainly. I mean, that was a trend that started a while ago. It's been ongoing because of the rising cost of wages in China and to diversify supply chain risk. Certainly, the trade uncertainty has accelerated that trend. But I think one should remember that the container shipping industry is about big container ships, 20,000 TEU massive container ships that are geared for ports in China, big ports in Europe, big ports in the U.S. If you shift production to lesser capable countries, supply chain-wise, I don't want to name one or be disrespectful, those 20,000 TEU ships can't go in those ports. So you have to employ a feeder network. So there's a potential big disruption in what has been a very reliable supply chain. We have come to rely on sourcing in China being very reliable in terms of meeting retail demand. So that has a potential for disruption until the infrastructure catches up with the shifting of production.
Jim, give us a line on IMO 2020, the more stringent marine fuel regulations that kick in then. Will it mean higher costs for an industry that's already under strain and under pressure? Is the industry ready, and does it inevitably mean higher rates for customers?
Well, there's several questions in that. Obviously, this policy was articulated in 2016. It's not really a surprise. The industry, unlike domestic transportation, has struggled with having a real reciprocal fuel formula. So the short answer is if fuel goes from $400 a ton to $700 a ton, due to the use of low sulfur fuel, that's an increase of about $300 a 40-foot container. So it would increase prices. I think more importantly is that the industry needs a reliable fuel formula up and down in terms of being able to adjust as fuel prices change, because fuel is more expensive than actually the capital cost of a ship, basically. So I think it's a good thing. I mean, it's a good thing for mobile source emissions. It will have an impact on cost. I think what I sense is that everybody is reacting to it pretty maturely in a pretty business-like way. And I'm hopeful that it may have a bit of a Y2K aspect. In other words, the difference in prices will not be as much as everybody fears.
And Jim, can you, as a final question, can you just give us a sense of any capacity constraints, bottlenecks, etc., that you chaps are having to deal with in South Carolina? And does that point to the need for a major infrastructure package by the federal government to overcome and alleviate those strains?
Well, I think the studies show that our infrastructure in the U.S. for the most developed country in the world is really lacking. As I mentioned to you, we're investing $2 billion in infrastructure related to the port. We have a state that's very supportive of our port because it's a major strategic asset. We've been a manufacturing state. We're diversifying into retail distribution now. So we have planned our capacity just in the nick of time, I would say, for the next 30 years. We're raising cranes to handle the big ships. Every dimension of the port changed to handle big container ships. So I think we've been fortunate to have the support and be able to realize our ambitions to keep up with the increasing ship size. Container shipping is all about deploying big ships. That is the main strategy. And if a port's not ready to handle that, then it loses out on handling volume, and the related region loses out as well.
Jim, fantastic conversation. Thank you very much indeed for those insights. Thanks for joining us. Jim Newsome there of the South Carolina Ports Authority.